Everyone says the same thing about Roth conversions. What tax bracket will I be in when I retire? They assume that's the key to deciding whether a Roth conversion makes sense. But here's the truth most people never hear. Your future tax rate is just one piece of the puzzle. Now, according to research from Vanguard, and we'll link the report in the description, your future tax bracket is rarely the biggest driver of whether a conversion pays off or not. In most households, the math is shaped by a few deeper mechanics that almost no one thinks about, and very few advisors even bring up. Let's walk through the real drivers, starting with the one most people almost never consider. Where you get the money to pay the tax matters most. When you convert money to a Roth, you're not just moving dollars from one account to another, you're choosing which dollars to sacrifice to pay the tax bill. And some dollars have far more long-term value than others. The first scenario is the most common. You paid the conversion tax directly from the IRA you're converting. On the surface, that seems reasonable. But when you pull funds out of the IRA to pay tax, you shrink the amount that ultimately gets to grow inside the Roth. You also reduce the pre-tax money that could have continued compounding in the IRA. In this case, the conversion becomes almost a wash. Your break-even tax rate ends up roughly the same as your current bracket. You didn't gain a head start, you just shifted dollars around. Now let's look at a different source of funds. Paying the taxes from a tax-efficient taxable account, something like a broadly diversified index fund with very low turnover, an account that's grown efficiently with minimal drag from annual taxes. In this case, you're replacing an already efficient asset with something even stronger, a Roth. The result is your break-even tax rate drops, but not dramatically. Meaningful improvement, but not a game changer by itself. Now here's where things really shift. Paying taxes with a tax-inefficient taxable account. Assets that generate ordinary taxable income every year, high dividend funds, active management portfolios, anything taxed as ordinary income, these dollars effectively get taxed to death over time. So when you pull these inefficient dollars out to pay the conversion tax, you're pulling money out of a tax-hostile environment and moving that value into a Roth where it grows completely tax-free forever. The net effect? Your break-even tax rate can drop significantly because you're upgrading a weak, low-growth dollars into one of the strongest tax-efficient vehicles available. Finally, paying taxes with cash, your least productive long-term asset. Cash barely grows, it loses purchasing power, and it does almost nothing. So when you use cash to pay for a conversion, you're effectively saying, I'm willing to use my weakest asset to supercharge my strongest. In many cases, this is where a conversion that looked borderline becomes a clear yes. The second factor, your non-taxable basis in your IRA. Now, let's talk about the second hidden driver, your basis inside your traditional IRA. Here's what that means in plain English. Basis refers to any part of your IRA that came from non-deductible contributions, money you already paid tax on when you contributed it. And that matters because when you convert basis dollars to a Roth, they move tax-free. Only the taxable portion of your IRA gets taxed. This is where the math gets interesting. The more basis you have, the less tax you owe on conversion, and the lower your break-even tax rate becomes. But here's the kicker. Most people have no idea whether they have basis or not. The IRS tracks it on Form 8606, and if you've ever made non-deductible contributions or rolled accounts, you might have basis you never realized was there. This alone can dramatically change the conversion equation, sometimes lowering the effective tax hurdle by 40% or more. The third factor, unlocking future backdoor Roth contributions. Now here's the one that almost no one thinks about, and yet it can quietly create the biggest advantage. If you have pre-tax money sitting in any traditional IRA, you run into something called the pro rata rule. In simple terms, if you have any pre-tax IRA balances, you can't isolate after-tax money when you do a backdoor Roth. Everything gets mixed together. That effectively blocks the strategy for many high earners, even if they technically qualify for a backdoor Roth. Vanguard highlights two ways to clear the path. One, convert your pre-tax IRA funds now, or two, roll your pre-tax IRA into a 401k plan. Most employer plans don't count toward the pro rata rule, so moving money into your 401k clears the deck. The result is clean access to backdoor Roth contributions for the rest of your life. And when you accumulate decades of future Roth growth, the impact becomes enormous. Vanguard modeled an example. An individual in a 35% bracket with some basis and future clean contributions saw a break-even rate drop to as low as 2.6%. That's not a guess. That's math. So, what really matters? Now, step back and look at this clearly. Your future tax bracket? Yes, it matters, but it's just the starting point. What truly shapes the outcome is where you get the money to pay the tax, whether your IRA has non-taxable basis, and whether a conversion unlocks future Roth contributions. And these factors, not a future tax rate, are what drive the real long-term benefits. So instead of asking, what tax bracket will I be in later? Ask better questions. Which dollars should I use to pay the tax? Do I have after-tax basis in my IRA? Will this move unlock decades of Roth growth? Once you think this way, conversions stop feeling like guesses and start becoming strategic financial decisions. Conclusion: planning with clarity. Roth conversions aren't about being right about taxes. They're about understanding the entire system and using the hidden levers to your advantage. When you choose the right dollars, leverage your IRA basis, and unlock future contributions, your conversion becomes far more powerful than most people imagine. Remember, it's not just about saving on taxes. It's about building long-term, tax-free wealth that compounds for decades. And that's how smart planning makes a Roth conversion truly pay off.